Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm going to take a look at Dollar General. This is a company that just had their Q2 earnings on Thursday. I'm shooting this on Friday morning, 9/1. So happy September, happy extended weekend. We're going to look at those earnings, see what happened to the stock price. It was actually down about 12% or something of that nature. And as of this morning, I'm shooting this at 9:32 a.m. It's down another 2.3%. So certainly some downwards pressure on the stock. As always, I'm going to look at their financials and then do a quick price analysis, valuation analysis to see where I'd be interested in buying this stock. It has certainly fallen on hard times recently, but it's a long-term compounder for investors who have held it for quite some time, even after recent price action. So if you're not familiar with Dollar General, this is an American chain of variety stores. They offer a bunch of stuff. I have a weekly ad pulled up here. You can kind of see where their bread is buttered. So mainly packaged goods, some housing stuff, some other random items. So not really anything specific, but think of an all-encompassing store, maybe a smaller type Walmart, except they don't really seem to offer any fresh items. I've never actually been to a Dollar General, but I kind of know what their deal is. They mainly serve underrepresented areas in terms of grocery stores, etc. They kind of target that less affluent demographic, maybe some rural areas as well that might not have access to a lot of this stuff, and they offer it at a good, affordable price point. So these stores generally do pretty well in a recession when times are tough, etc. But they can also struggle with some other items that we'll talk about during their earnings as well. As always, guys, I am not a qualified financial advisor, but if you do enjoy these videos, please make sure to like and subscribe. I'll be doing more of these videos quite often going forward, and let me know what you think about Dollar General and the video in general down below as well. And also let me know if you want any specific stocks covered. So jumping quickly into the earnings now, you can kind of see why the market wasn't all that impressed. They were expecting closer to, mid to high single digit growth, but Dollar General basically showed some increases on the sales side, growing 3.9% to 9.8 billion for the quarter. But that was mainly driven by new store ads. They added about 300 plus stores during the quarter, as they often do. Same store sales actually decreased 0.1%. And then a bigger hit is that operating profit decreased 24%. Diluted earnings per share decreased 28%, and year-to-date cash flows are much lower than they were before. So really what you're seeing here is a lot of pressure on margins, which for a store like this, where margins aren't necessarily super thick, is a little bit of a problem. They are a dividend payer. They declared a quarterly cash dividend of 59 cents. That's continuation of what they had before, no raise, but they don't generally raise until 2 quarters away from now. So really the problem here is that there's some additional cost pressure on the business. They talked about, maybe the consumer being a bit more pressured in terms of what they're spending their money on. That's been a call out on a lot of retail calls in the last couple of weeks slash months. Certainly the consumer is being pressured, but generally the consumer, if they're pressured, would sort of go to stores like this, but they're not really seeing all of that pressure move into their stores. Maybe they're seeing some pressure from other comparable companies. I think Dollar Tree actually did it a bit better in their Q2 earnings. And obviously people have the option to go to other places like Walmart, etc., Costco, etc. If there are actually cost pressures, maybe buying in bulk is a better deal since Costco's still doing relatively well. Inventories are a problem for them. They're increasing at 3.4%. Another problem with their inventory side is that shrink is a much bigger issue than they let on. In Q2, they had obviously called out shrink as a problem, shrink being theft, loss of merchandise, etc. They basically said that between Q1 and Q2, they had to increase their assumption by as much as $100 million for the year. So they're going to lose an additional $100 million in inventory just to shrink for the year. And that is pretty big. I kind of talked about Dollar General being in maybe less economically privileged areas, less affluent shoppers go there, and maybe that will lead to increased shrink and increased theft, and that is going to put pressure and quite a bit of pressure on the margins of a company like this. As the economy gets harder, as inflation hits more and more homes, it gets tougher and tougher to make ends meet for a lot of people, and shrink is going to become a bigger issue for these companies. Dick's just a couple of days ago called out shrink as a big issue, and I think it's going to be the norm for a lot of these companies that are in certain areas that are more impacted by that than others, especially as some of these states kind of don't do a lot to control theft and sort of allow it to happen. That's going to impact businesses like this and might lead to some store closures, etc. There have been some stories about store vandalism, etc., that have caused companies like Dollar General to have to close their stores in certain locations for an extended period of time, a short period of time, whatever. The other part of this business is that they mentioned this before, but they are starting to invest more in the business, whether it's upgrading stores, remodeling, etc., investing more in their employees. Generally, Dollar General has paid their employees a bit less than other stores, other businesses in certain areas, and that may be catching up to them. And as if you think about the business itself, as inflation becomes more rampant and other companies raise their salaries to kind of deal with it, to try to attract more employees, Dollar General will have to follow. And in order to maintain their margins, they may have to raise prices on their items. And since they are not really attracting that affluent shopper, if they can't eat those margins as well as something like Walmart can, because Walmart is also raising salaries, doing more investments in their stores, etc., they might not be able to attract the customers that they need to attract with higher and higher and higher prices to keep margins where they are. So if their margins start to shrink, and that's a long-term problem because they have to keep prices kind of low and shrink margins to retain customers, et cetera, to grow same-store sales on a go-forward basis, that might impact the way the market values the stock, because this has been a stock that has had pretty decent margins and margins that have been rising in recent years. And this is kind of the first time they've hit a skid and margins have started to fall in a pretty big way. So the other thing that these earnings announce is that, listen, this is not just a Q2 problem. This is going to be a problem that extends into 2023 as a whole. Generally, they expected 3.5% to 5% growth for the year. Now it's 1.3 to 3.3%. Same-store sales were expected to grow in the range of 1% to 2%. Now they're going to potentially decline as much as 1% or grow up to 1%. And then there's a 34% decline, a 22% decline, on the EPS side versus an expectation of an 8% decline to flat growth. So the decline is going to be pretty big, or it's 34 to 22% rather. Clearly margin pressure, clearly issues on the margin front, shrink, etc., investment in labor, etc., investment in elevating the store experience, etc., is a problem here. And they're expecting capital expenditures to be pretty large, just as they were last year. They're still opening new stores. If you think about it, they need to do that to continue growing. But if they're only growing 1% to 3%, despite opening 990 stores and remodeling 2,000 of them, that's not really good results. So what's going on here, and what's the long-term picture? Well, what's going on here is that this is a company, I've got the free cash flow margins and the operating margins pulled up. This is a company that has historically had margins, or at least on the free cash flow side, in that 3 to 4% range. In recent years, kind of past 2015, those have grown into that 5 to even 8% range. As of 2021, when the stock kind of exploded, people were like, wow, if this is the new norm for Dollar General, this is going to be amazing. But those have kind of fallen off quite a bit in 2023. Their free cash flow margins were barely anything. You can kind of see a similar story on the operating margin side. Growth, and they're kind of slowing down again, coming to a skid, and that's showing up in their earnings. How does the balance sheet look? The balance sheet is still pretty decent. Let's get rid of this stuff. They do have some issues because they don't have a ton of cash, a little bit of debt, and obviously capital leases. They rent out a bunch of their stores. In recent years, they've taken on some decent debt, mostly to buy back shares. And I don't know if that was the best use of their money, since now they have to pay it back, and as free cash flow slows down, they may have a bit of issues on the debt front, but it's not really anything I'm hugely worried about. I think the balance sheet is still decent, not a ton of concerns here. And then cash flow, which we'll look at really closely soon. They've done a pretty good job of buying back shares in the last couple of years, but that is slowing down quite a bit. They basically said on the Q1 earnings, we're not really going to buy back any shares anymore. Q2, they didn't buy back any shares. Now that the price point is falling, getting a bit more interesting, you would want management to start getting back on that share buyback train, but they're not really doing that yet. And maybe the reason for that is we know the cash flow is going to be limited on a go forward basis for a little bit of time. Margins are pressured, etc. But we will see where that takes us and whether or not we have the ability to buy back shares, especially since we're investing a lot more on the CapEx side, whether it's employees or remodeling, et cetera. You can kind of see that in recent years. Maybe as their stores have gotten older and staler, et cetera, they have spent a lot more money on CapEx, and that is going to continue into 23 and 24, seemingly based on what they said here, which is going to impact their free cash flows. So we'll see how that works, whether they are able to recover those margins via price increases, or whether the customer they attract is going to simply go elsewhere because they can no longer afford what Dollar General is giving them, and other companies are able to weather that margin pressure a bit more. That's kind of the story with retail these days. It's shrink, it's margins. How are they going to work around that? That'll be interesting to see. And like I said, they do pay a dividend, but it's a relatively small one, so not a huge impact to their overall cash flow. So let us look at their financials. I've got a little bit of a work up here that looks at their stock. Right now it's at 135.38. 135.28. Let me hard code that so it doesn't change while we are looking at the analysis. Obviously, this is going to be slightly different depending on every second in the market. This is a company that, like I said, has grown revenue at a pretty decent clip, had a good 23. Free cash flow margins have been relatively steady in recent years, kind of averaging that maybe 5.5% range, with 21 being an outlier. But prior to that, prior to 25, prior to 26, they were more in that 3 to 4% range. And maybe that's kind of the historical norm that they'll have to get back to with some of these inflationary pressures. As we look at 2023, their margins really dropped off as CapEx increased. The expectations are that margins go up in 24, 25 and 26 kind of stay steady or move upwards, and then they return to some more growth past 24 and 25, despite slowing growth in 24. Don't know if that's realistic. I mean, we are using 23 actuals as this free cash flow yield, but I think that's a bit understated simply because maybe they spent a bit more on CapEx. Maybe there were some inventory shifts. If you look at their cash flow, obviously the inventory had a big change on the negative side, whether it's shrink, whether it's just inventories getting up there. Maybe we normalize that just to have a more realistic view by adding about $1 billion to get to a more normalized cash flow as a baseline. We won't use that for anything. This doesn't impact our analysis in the future, but that's maybe something you might want to do as an investor if you have a 1-year investment cycle or a 2-year investment cycle that isn't expected to continue forever. If it is, then obviously this is a problem for the business, but let's assume it's not and use that as a starting point. So if you use that, or if you use 2022 actuals, the market is giving that, a 4.8% free cash flow yield or something of that effect. If you assume these valuations are going to continue, these growth numbers are accurate from analysts. At the similar yield, it's about a 12.4% return. I'm assuming about 25% of our cash flow going to buybacks, which is about $2.4 billion, which again, if you look at the last couple of years, they've actually bought that much back every given year. But like I said, they're not really buying back shares this year. So maybe that's even less than you're going to get. So buyback yield may offer further upside. And then I am assuming about 7% growth on their dividend, which is what you saw in the last year. So right now they're paying about a 1.7% dividend yield, but going forward to 2028, maybe they'll be up to a yield on cost of about 2.3% at today's prices, assuming 7% growth. So if you think the market's going to give this type of valuation to Dollar General in 2028, this growth is something that you find reasonable. You're looking at about a 13.8% return from here, assuming this buyback, assuming this type of dividend growth. A lot of assumptions here. I think with slowing growth and tightening margins, potentially 4.8% is a bit rich, especially since we're making an assumption here that it's actually 4.8% today and giving it the benefit of the doubt. If interest rates stay elevated, they may have some pressure on the interest expense side due to their debt. Again, so half of this is capital leases, but it's still an expense that they have to deal with. Maybe there's some inflationary pressures on their rents, etc. Although most of them are probably relatively long term, so they might have 2 to 3% escalators at best. So it's probably not that much of a big deal. But if you look at it that way, then if you need a better yield, better valuation from the market, you're looking at a slightly lower total return, even inclusive of buybacks and or dividends. For me, though, this seems a bit optimistic, especially in 2024, which we already are 2 quarters into. This is their 2024 fiscal year, not actually 2024 calendar year. We've already seen that they're going to show 1.3 to 3.3% growth on the revenue side on the estimate. So I'm kind of putting that right in the middle. And then free cash flow margin, even at 2%, is probably optimistic. If you look at their first 2Qs in 2023, 2024 fiscal year, they're basically close to zero margin. So 2% might be optimistic here. And that, again, is kind of tying back to the 1% margin you saw in 23. They're spending as much as they are in 23 for CapEx in 24. So maybe even 2% is optimistic. Maybe you'll get closer to 1%. So we're not normalizing because that doesn't impact what we're going to do, but it does impact future valuations. As you can see, if I move this to 5%, your total returns actually change. So we'll leave it at 1%. And then potentially going out to 25, 26, 27, 28, my assumptions are there's some sort of revenue growth again. And I do think the enticing part of this business for a lot of people is that generally this type of business does well in a recession. If we're headed for a recession, people are going to look at price points that are attractive, and Dollar General has that. They're able to offer certain items at reduced prices. They have a lot of people who use coupons there to save additional money, etc. They offer a lot of deals in their weekly ads, etc. So potentially some growth into 25, some slight growth into 26, 27, and 28. And then I'm generally saying that the margins are going to come back to more of their historical norms, not really their 5 to 7% to even 8% margins that you saw in 2021 and 22. But we are going to kind of get back to that 4% historical norm due to the investments they're making, the higher salaries they're paying, potentially the higher building rents they might have to pay, et cetera. More costs that are not being passed on fully to the consumer because they have to retain their status as a low price point store. So maybe those margins aren't as hefty as they used to be, and that puts some pressure on the stock price. And I don't know if the stock price is fully pricing that in, because if I look at it that way, even at today's free cash flow yield, it's only a 7.6% return. And with slowing growth, maybe some growth pickup in the back end here, and margins that are leaner than they were in the past couple of years, and assuming that interest rates stay elevated, you're thinking that you need a slightly better valuation from the market. So maybe you need to be in that 5 to 7% range. And that only gives you a 1 to 7% return. That's not all that interesting. I think what would make this interesting is maybe that $100 price point, which kind of puts that into that 7 to 13% return range. And maybe my assumptions here are a bit pessimistic, but certainly they're not super unrealistic given what we're seeing in the marketplace today. And if I am uncertain about a company like I am about this one, retail is not really something I'm super in love with for the most part, because I just think the online shopping experience is so much better. And certain things you can't get online. Maybe groceries are one thing that I still buy in person for the most part. But a lot of the things that Dollar General offers aren't the items that I'm looking for. They're not really the fresh items, etc. They're more the box stuff that you can easily get online or in bulk at Costco. So they might see some pressure on a go-forward basis, some more pressure on some of that stuff from some of those online retailers, and also obviously some of the theft issues that they're dealing with, some of the cost pressures they're dealing with on the salary side, on the employee investment side, on the improvement of their building side. Some of that CapEx may be more reoccurring in nature. They were a company that had 500 million in CapEx every year for a while, and now it's 1.5, 1.6 billion. That is going to have a significant impact to your bottom line. You're basically saying that you're adding an additional billion in CapEx and expenses. So that is going to totally impact your free cash flow margins as you're seeing in these years. And maybe the assumption is that not all of that is permanent, but maybe they're increasing by 750 million every year instead of 500. And it's going to be tough to make that up on the margin side. So margins are going to be impacted. So maybe I need a $100 price point to enter this. And that gives me a current yield of about 2.4%, a future yield of 2.8%. And even if you're more bearish here, maybe you need something at a 7% cash flow yield. That gives you closer to 10%, which is an $85 price point. Not ideal because it's 35% below where you are today, but that's kind of my thought process. Now, obviously, you may say I'm too bearish here. So let's say that, yeah, 2023 is a bad year. I guess this should be 2024. Actually, this isn't reference. So 2024 is a bad year, but 2025 gets better and 2026 gets better. You could just ignore these numbers because they don't reference what they should reference. I'll update that. And then the growth returns. So your free cash flow margins start to get back to historical norms and your growth starts to return. And even then at today's price point, you're still kind of looking at a 13.3% return at the 4.8% free cash flow yield that you're getting, which isn't bad, right? Maybe at that point you're saying, well, 4.8% free cash flow yield is the right number, and I'm happy with a 13% return. I'm happy with a growing dividend, etc. So if you feel more bullish about their ability to retain their margins to get back to free cash flow margins that are more in line with historical norms, maybe even 5.5%. At that level, you're getting closer to 15% total returns. Maybe you're thinking that, hey, growth is going to return to the 7 to 8% we saw earlier that I'm even projecting here. At this price point, this is not a bad bet. But for me, given what I'm seeing here, I probably need a bit more of a margin of safety. And that margin of safety is, hey, if the valuation of the stock gets a bit worse, if the growth isn't as quick as the market projects into 26, 27, 28, if the margins don't really recover to those 5% norms that we had from like 15 to 21, 22, they actually recover maybe to those 4% norms we had prior to 2015 when the economy wasn't, doing as well, when costs were a bit more expensive, interest rates were a bit higher, investments in store openings and store remodels maybe were a bit higher, employee salaries going forward are going to be a bit higher. If you think CapEx is going to be elevated for a while, they do have 18,000 stores. They have to remodel a bunch of them every year since they're probably pretty old at this point. They have to make them more attractive to the newer age consumer who can just go online and buy a bunch of this stuff at potentially similar price points and get it delivered to their home. And yes, they often exist in areas that are a bit underserved. So maybe they are sometimes the only option. That can be a good thing, but that can also be a bad thing because shrink is increasing across the board. When the economy gets tougher, that is still going to be a problem. They are saying they're going to have a lot of shrink. They're basically telling you it's going to happen. So for me, I'm going to need a bit more of a margin of safety to invest in this. And that would mean price point somewhere around $100. So it's quite a ways from there. It would basically mean that the stock price is falling way back to, to prices that we haven't seen since 2018-ish, something like that, which is probably a bit optimistic. But if you look at the chart, certainly the stock isn't doing well. The market isn't loving what they're doing. Will this ever get to $100? Maybe not. Maybe I'm being a bit too pessimistic about their prospects. But if you do get another earnings release that kind of sucks, where margins are compressed, where they start to give you the next year's projection, and it's also, hey, the growth is going to be bad again, margins are going to be bad again, then this is a longer term story where the thesis is going to need a long time to play out, because at the end of the day, they need to get back to those 4 to 5% margins for this price point to be worthwhile. And right now they're not there yet. And if they don't get there pretty quickly, then $100 may not be out of the question. So that's what I'm looking for. That's where I'll put this price point as a notification for me. Yeah, hey, if I get a notification that it's $105, maybe I'll buy Dollar General. But until then, not for me. Let me know what you guys think about this company. Maybe you are more optimistic about their ability to get back to free cash flow margin or operating margins that are more in line with their historical norms. But I don't know if I'm all that ready to pull the trigger on it yet. So Thanks for watching, guys. As always, guys, please remember I am not a qualified financial advisor. Please do your own due diligence before making any investment decisions, but leave a like down below, subscribe to the channel, let me know what you think, and as always, have a good rest of your day.